Hello. Thank you all for joining us today. I'm here with our founder and executive chairman, Michael Saylor. I'm Fong Lee, president and CEO of Strategy. And I'm excited to share with you our latest perpetual preferred offering, STRC, also referred to as Stretch. I'd like to start with our disclaimer, and I suggest you all read this in detail at your leisure. And let me go through the term sheet at a high level. Michael will go through a lot of these terms and the strategy of Stretch in more detail later. I'll start with it. This is our fourth and latest security that is perpetual and preferred in nature. And in terms of seniority, Stretch is senior to Stride and Strike and MSTR common stock, and it will be junior to our other debt, including our convertible notes, and also junior to Strife. The stated amount of Stretch is $100 per share. And what's unique about Stretch is our intention is to maintain a trading level for Stretch that's near a stated amount. We have a few mechanisms to try to create this outcome. First of all is a variable dividend rate, which is unique and different than the dividend rate, which has been fixed on our other perpetual preferred securities. The second is an ATM, which we intend to issue in short order. And we'll use that ATM also to help us maintain the price at the stated amount. And the third is a unique call option that we also will describe later, and Mike will go through. So let me go through a performance review of Strategy and the company to date. And I'll start with a chart that some of you have seen many times, and one that we're quite proud of, which is the annualized asset performance of Strategy since the Bitcoin standard era, which started on August 10th of 2020. On an annualized basis, you've seen our return is about 104%, which is nearly twice that of Bitcoin at 59%, and nearly 4 times that of the Mag 7 at 27%. And if you look at the total returns during that same period of time, we have returned 3,324%. in nearly a 5-year period. If you look at the last 12 months, you'll see similarly remarkable returns, 172% for MSTR compared to 85% for Bitcoin, 36% for gold, and 23% for the Mag 7. In the second quarter of 2025, we saw an addition of $21 billion of digital asset value. About $14 billion of that is via an unrealized fair market gain on our existing Bitcoin, and additionally in Bitcoin that we acquired during the second quarter, and $6.8 billion of Bitcoin that was acquired during the second quarter. So we've really added tremendous value to our balance sheet during this period of time in the second quarter, increasing it by nearly 50%. If you look at the performance of Bitcoin, and as a result, MSTR's balance sheet and digital asset value since the second quarter, in a very short period of time, really just about 20 days or so, you'll see that we have added an additional $7 billion additional asset value, $5.7 billion or so because of the appreciation in Bitcoin price going to all-time highs that we've seen, and $1.2 billion of additional Bitcoin that's been purchased today. And the result of this is a balance sheet that is now in the top 10 in the US companies, excluding financial services companies. We are well exceeded the balance sheet of tremendous companies like NVIDIA, and we're honing in on some of the Mag 7 companies like Meta, Apple, Microsoft, Google, and Amazon. So we've really created tremendous value in the second quarter and really in the last 5 years through our Bitcoin acquisition strategy. Our two primary KPIs that we measure ourselves against are BTC yield, where we have an annual target of 25%. And you'll see here year to date, we're at 20.8%, so nearly 80% of the way through achieving that BTC yield target. And the BTC dollar gain target that we've set is $15 billion, and you'll see we're at nearly $11 billion, so more than two-thirds of the way through achieving our BTC gain target. The performance of our perpetual prefers that we've issued year to date, Strike, Strife, and Stride, have been tremendous year to date. And it's a great backdrop for us to be introducing Stretch. I'll point out here that Strike was launched in January of this year at an $80 price, and it has increased 48% since then to $118.2 billion, $118. And we've added $549 million of Strike through ATM sales. On Strife, we launched at $85 and seen similarly strong performance, 40% increase and $219 million of ATM issuances. And our most recent IPO was Stride, which was launched at $85 and seen a 10% gain during that period of time and $18 million in ATM sales. And so compared to the preferred universe and the preferred index PFF, the performance has been significantly better, right? Strike here with an ARR of 104%, 48% performance compared to -2 for the PFF index. Strike has an ARR of 123%, 40% increase compared to 0% for the PFF index. And in a short period of time, Stride has shown 87% ARR, 10% performance versus a 3% for the PFF index. And so those have all performed very well. And what has occurred is because of the increased performance or the high performance of these instruments and the increased price, the yields have started to go down. And with the lower effective yields, when we issue the instruments via an ATM, it actually increases the Bitcoin torque, and it increases the accretion to shareholder value with a lower effective yields and increase in Bitcoin torque. So we've seen very strong performance, and we've been proud of that. And again, I think this is a great time to be launching Stretch. The final piece that I'll walk through here is the amount of equity we have been able to raise through these instruments and how it has started to increase significantly over time. You'll see here we had a record week 2 weeks ago of $141 million of ATM issuances through our 3 instruments. And this is going to be our primary way over time to lever up the balance sheet, to add performance, to add BTC yield, to add BTC dollar gain, and BTC torque to our business. So with that, I'll hand this over to Michael Saylor.
Thank you, Phong. I'm just really excited about Stretch. Stretch is the newest member of our preferred stock family. It's senior, it's perpetual preferred. It's a variable monthly dividend, and we've designed it to maintain a stable price. You know, the par value is 100. The dividend at par is 9% coming out of the gate initially. Initially, it's about a BTC rating of 7. And we pay it monthly, and then the dividend may adjust monthly. We're building out the yield curve with Stretch. So we've got a convertible preferred. We've got a long duration senior fixed preferred. We've got a long duration junior preferred in the form of Stride. And Stretch is filling a different part of the credit market. We want it to be short duration. Not, it's not a 20-year or 30-year, Bitcoin bond. It's meant to be a 1-month Bitcoin instrument. And so if you think about the way you'd price that, we've got about a 340 basis point credit spread above the 20-year treasury bond for Strife. And so the effective yield of Strife is 840 basis points. You can see the spread there. If you were to take that same spread and apply it to Stretch, and you were to benchmark that against the 1-month treasury, then that suggests the equivalent Stretch yield would be about 7.7%. Now we're offering 9% out of the gate. Initially, we're pretty excited about the instrument. If we price Stretch the IPO at 95, it'll be 9.5%. If we price the IPO at 90, it could be up to 10%. STRC is designed so that we can mitigate volatility. We want it to be the least volatile, shortest duration instrument. we're targeting price stability. So if you look at SOFR, if SOFR were to decrease, then a preferred like Strife that has a fixed dividend will tend to increase in price. And when SOFR increases, a fixed dividend instrument will tend to decrease in price. And so that's an example where you hold the dividend constant and the price fluctuates. You're getting volatility. The instrument's actually engineered, it's designed so that that happens, and it's for a certain type of investor that wants that type of sensitivity. Now, stretch is meant to be different. It's if you want the price to be less volatile, if you want to target a certain type of stable price, then you have to move something else. So the dividend changes, and you can see here that by adjusting the dividend monthly and reacting as appropriate to SOFR, then we have a mechanism, right, that we can use in order to decrease the volatility of STRC and change the characteristics of it in the aftermarket. The other thing that's different about stretch is it's not a quarterly dividend, it's a monthly dividend. And we've heard from a lot of people that investors value monthly cash payments or monthly cash dividends. So the 15th day of the month will be the record date. And then on the last day of the month, we'll pay the dividends in cash, and then we'll set the next month's stretch rate. And then we'll just do that with a simple monthly cadence. Now we have a number of mechanisms to execute the stretch credit strategy. How do we make this instrument a success? Within the target range, we have the mechanism. We can adjust the STRC dividend rate and the STRC issuance via the ATM. When the price falls below our target range, then we would cease selling any STRC per the ATM, and we have the option to increase the STRC dividend rate. Now, what happens when STRC trades above our target range? Well, we have a mechanism. We could decrease the stretch dividend rate. We could issue stretch via a secondary offering at or below 101, or we can call stretch using the call option embedded in the instrument. So you can see it's a variety of mechanisms. They're novel. Most of these mechanisms, I don't think you saw them in Strike or Strife or Stride, because those are different instruments for a different type of credit investor, right? Stretch has got a very particular goal that we're pursuing. And what kind of investor would we like to find? Who are we targeting? Well, we're targeting short duration, lower volatility investors in credit that are looking for, a yield. So if you're buying a money market, you might be getting a 4.2% yield. There's $7 trillion in money markets. Maybe you're buying short-term T-bills. Maybe you don't want interest rate duration risk. You don't want to worry about the kind of movement in the principal that takes place in a 20 or 30-year swap. There's US dollar denominated bank accounts, a lot of them. There's corporate commercial paper, right? And so these are big markets. Our offering is $500 million. It's not so big. And you can see we're looking for those kind of credit investors, and we're offering 9.5 to 10% effective yield for people, or for investors that are comfortable with a BTC backed credit instrument. This slide shows a different view of that universe, and you can see they're just very large markets. We're going to enter the market, and of course our differentiation is a Bitcoin-backed instrument with a much higher yield. And of course, this slide just shows how big this entire credit market is and how small our entry is. Ultimately, our focus on Stretch is we want it to be a very unique type of credit, a very strong form of credit for those that believe in Bitcoin and are enthusiastic about the crypto economy. Now, a lot of people will want to compare it to Strife. They're both senior perpetual instruments, but Strife's quarterly, Stretch is monthly. They're both cumulative. And Strife, because it's got a long duration, it's going to actually be more volatile to interest rate fluctuations. And Stretch, because it's a much shorter duration, should have a different volatility profile. And we've got that charted here on this slide as well. You can see on one hand, we've engineered Stretch to be our least volatile instrument. And on the other hand, we've engineered MSTR equity to be our most volatile instrument. And then we offer, various flavors in between for various types of investors. Now, Stretch's credit is backed by our capital structure. And so we've got a $71 billion Bitcoin stack and this $132 billion equity stack. So we have $59 billion Bitcoin surplus and we have about $120 billion equity surplus. If you think about the capital structure in that configuration, you can see the debt is fairly well collateralized. You can see the preferred instruments, have BTC ratings between 5.8 and 7.7. If you're a skeptic about Bitcoin, then you can see there is some risk here, and we've calculated the statistical risk and calculated the BTC credit spread that you need to offset that risk. But you can see even after that credit spread, you can see there's still a spread premium here. If you're a Bitcoin maximalist and you think Bitcoin's appreciating 30% a year, then you can see that risk, almost goes away. It falls down to single-digit basis points, and the BTC credit spread goes to 0 or 1. And so if you're a Bitcoin maximalist and you believe in Bitcoin and you're looking for credit instruments, you would be very enthusiastic about the credit that we're creating. Now, we also, scenario out and consider what happens if we actually equitize our convertible bonds. And you can see here, if we were to equitize them at the earliest allowable call date, they'll all go away by 2029. And that's something that everyone should be thinking about. We think about it. Now, we've done a pro forma capital structure, and the pro forma says, well, what happens if we equitize all the convertible notes that are currently in the money? So not the entire stack, but the ones that are in the money. And you can see that it cuts our debt down to $5 billion, and it increases the Bitcoin surplus and increases the equity surplus. When you start to plug in that new capital structure, the BTC ratings of all the instruments move up. Strife and Stretch move beyond a BTC rating of 10. You can see the remaining debt would have BTC ratings of 14 to 35. Now you can look at the various BTC credit that pops out, and you see the spread premiums. But, you start to see a very different capital or credit structure. And of course, if you're a Bitcoin maximalist, you can see the risk, collapses to just a few basis points. And in fact, the BTC credit spread falls to 0 basis points for all 6 of these instruments if we were to do that for Bitcoin maximalists. For anybody interested in this, you can go to our website, strategy.com, and you can plug in the Bitcoin price you want. You can plug in your forecast for volatility. You can plug in your forecast for BTC ARR. It'll give you the BTC ratings, the BTC risk, the BTC credit. It's very interesting, and we're happy to share that model. Now, looking long term, and long term for us is 3 years out. We're really thinking about a capital structure where Strife would be at the top. And we would be targeting a BTC rating of 10 or more. And Stretch would be second. But we're also targeting 10 or more. We want these to be our highest rating, our highest rated, most secure, most over collateralized BTC credit instruments. The mezzanine instrument will be Strike with a BTC rating of 6 or more. The high yield instrument will be Stride with a BTC rating of 3 or more. All of those credit instruments will be supported by Bitcoin, our Bitcoin stack, which is the hard asset, which is liquid, and they'll be also supported by our equity in the equity capital markets. And so you can see that's our long-term BTC capital structure. And when you start to crank that in and you think about what's the plan, you can see that our ability to issue credit, it'll be a function of the appreciation of Bitcoin. It'll be a function of the increase in our equity capital base. It'll be a function of the issuance of the junior instruments as we issue more Stride, that will actually make Strike, Stretch, and Strife more credit worthy. So there's a lot of opportunity here, and all of these instruments are very reflexive to each other. The issuance of one generally results in an improvement in the prospects of the others. So I've laid out our capital plan and our credit strategy here. You can see our long-term targets for the 4 instruments in the credit structure. Our plan is that we'd like to reduce our overall senior convertible debt outstanding over time, and we'll seek to equitize that as the options arrive and as available, and we'll simplify our capital structure in order to elevate the BTC ratings of the remaining credit instruments. As we move forward, preferreds are our preferred credit instrument, and they'll remain perpetual. We think that keeps our flexibility, maintains flexibility, but also minimizes default risk. It's just best for our credit strategy. And then we're going to time our future offerings, and we'll size them to maintain our target BTC ratings and to preserve our tiered risk and yield integrity across the stack. And our business strategy is we want to be the leading issuer of BTC-backed credit instruments in the world. We are now. We don't see any reason why we shouldn't grow that business and continue to be the leader in that market. We'll do it with very clear credit standards, a disciplined approach to leverage, and very transparent capital allocation. Our goal for Stretch is we're targeting low volatility, short duration, high yield credit, right? Stretch is meant to be strong credit. It's for credit investors. They don't want long duration. They don't want volatility. They want the highest yield they can get if you can diminish the volatility and shrink the duration. How are we going to do that? Well, we're leaning on 4 pillars. MSTR, the issuer, has a 35-year track record. We're a well-known, seasoned issuer. We have $100 billion plus equity market cap, $100 billion plus options open interest. We have nearly $5 billion a day of equity liquidity. So a very well capitalized, seasoned issuer. We're also focused upon our digital capital strategy. So digital performance is really important. That's how we're going to generate the yield on these instruments, right? And the performance comes from Bitcoin, which has been appreciating 59% a year for nearly 5 years now. MSTR is appreciating 104% a year. So we are the bridge to the crypto economy. And as the crypto economy grows and the digital economy grows, we expect Bitcoin performance to continue, and we expect that will drive MSTR performance. And we expect that will be how we will fund and back these credit instruments. We're executing a treasury operation. That's the third prong of our Stretch support. right? We've got 4 ATMs right now. We're going to add a 5th ATM as soon as practicable with Stretch. We've issued $35 billion of securities over the past year. And we've got a 5-year track record issuing these securities into the marketplace. And so our treasury team will support Stretch, and we expect that's one of the elements that will make this strong credit. And then finally, the credit of Stretch itself is backed by 607,770 Bitcoin, right? The largest corporate Bitcoin stack, unencumbered Bitcoin that we can use as hard collateral. That gives Stretch a BTC rating of 7, on the IPO, and that means 7 times over collateralized. So when you think of Stretch, STRC, think STR means strong and C means credit, right? Stretch is strong credit, targeted to the credit markets, to a very particular type of credit investor. And it's unique in our credit stack. It's not like Stride, it's not like Strife, it's not like Strike, it's not like the equity. We think that we're bringing a very elegant and exciting product to the market. We hope that you'll agree with us. In our appendix, we've offered a review of our debt coverage. And as you can see, we've got a substantial stack of hard assets that covers our existing debt obligations. It's 14 times debt coverage right now. We've got a review of our dividend coverage. We've got 180 years worth of preferred dividends covered with hard assets. And even if we had a 75% decline in BTC, we'd still have 26 years of dividend coverage. We've got a review of our dividend obligations and how are we going to pay these cash dividends with our ATM. And you can see we've got substantial liquidity in our equity, and we feel confident that our ATM will be more than supportive for all of these dividend obligations. We've also got some detail on our KPIs we use. So if you're wondering around how we define BTC gain or BTC yield, and these various other BTC instruments, you can feel free to check out the footnotes. We've got a discussion of BTC rating here, and BTC risk, and BTC credit. We've been leaders in offering a Bitcoin equity model, and we're also offering our Bitcoin credit model. And so please feel free to look at these. We think these provide a strong statistical and mathematical underpinning for what we're doing, and they would be interesting to any Bitcoin treasury company or BTC equity investor or BTC credit investor. So with that, Stretch is our, it's our latest offering. We're very excited about it. It's unique. We think it's very special. We hope you'll agree with us, and I want to thank you for your time and your attention today.